So in this video, I wanted to talk about how you can convert a naked put, into a covered call. So if you've watched my previous videos, you've seen that I've had naked puts in my margin account. So I go into my positions here. I have naked puts here that I've converted to covered calls in my registered account, in my RSP, for example. So I just wanted to show exactly how I did that. So let's take the example of Lightspeed. It's a naked put that I have in my margin account. You can see I have the January 21st 30 put, so strike is 30. And my break even, what's my break even? My break even is the strike minus the credit that I received. I received $1. So my break even is $29. Now let's see what happens if I convert it into a covered call. It's actually pretty simple, but let's just talk some math. So all I have to do is sell the exact same thing as a covered call, same strike. So instead of being a put, it's going to be a call, but a covered call. So I'm gonna have to buy 100 shares. But if I do it at the same time, it's going to be the exact same P&L, exact same break even. Sometimes there's a small skew on the call side or the put side, so there could be a small difference in the break even or in the P&L, but it's still relatively close. And sometimes, depending on the bid and ask, how wide the spread is, there might be a bit of spoilage. So that's also another thing to consider. Obviously, the more liquid the underlying, the closer the value will be, the less difference will be between the break even and the P&L from converting the naked put into a covered call. So as you can see, I've got the 30 put here. It's worth, based on the last traded price here, it was last traded for 55 cents. So if I close this for 55 cents, that means that if I open a new covered call at a 30 strike, that means my break even on the covered call should be 30 minus 55, or 30 minus 0.55, sorry. So that means my net debit for the covered call should be around 29.45 if I want to convert a naked put of a 30 strike, where I'm going to pay 55 cents for right now. So if it's a 30 strike and I'm paying 55 cents, that puts my break even at around 29.45, exactly 30 minus 0.55. So if I convert that into a covered call, my net debit for the covered call will have to be 29.45. So I'll have to buy 100 shares at whatever the price is and then sell a call. The call that I'm going to sell has to bring down my net cost all the way down to 29.45. So let's try that. All right, so you see that it's trading for 55 cents. Now let's look at the covered call. So if I look up Lightspeed, LSPD. So first thing we have to do, this is the Canadian, sorry, LSPD. So the first thing we have to do is we have to buy 100 shares. You see the last traded price here was $40.80. So 40.8 for buying 100 shares. Now I have to get down to 29.45. So basically, I need to sell the 30 call because it has to be the same strike. I need to sell the 30 strike for $11.35. The 30 call for the same expiry as well, January 21st. So I need to sell the January 21st 30 call for $11.35 for me to arrive at 29.45 break even, the same break even that I have on the put side. So now if you look at the 30 strike for January 21st, we can see the last traded price was $10.30. Now that's not good. It's pretty far from my $11.35. Now the market is closed, so this is probably not accurate. Let's see if we can look at the quote. If we look at the quote, if we look at 5 days, yeah, it's still not obvious. Let's look at 5 days. No, nothing's coming up. So let's look at something more liquid like the SPY, so that the last traded price can be more accurate. Or let's even try the option chain on Yahoo Finance. Let's do that. So if I go to Yahoo, not sure if it will show for LSPD because it's originally Canadian. LSPD. Let's hope it has an option chain available. Okay, there we go. So January 21st on Yahoo, it shows that the 30 calls. So I'm looking at calls here. The 30 strike, the last price was 10.30, but that's not what we want. The bid is 10.70, the ask is 12.6. So this is what I was talking about, that it's going to be wide. So it's pretty wide here. You might not get exactly the mid price. So let's see what the mid price is. Hopefully it's around 11.35. So 10.7 plus 12.6 divided by 2 gives me 11.65. I said I needed 11.35. So as you can see, it's pretty close. If I can get 11.65, that actually improves my break even. Because if I can get 11.65 and the stock is trading at 40.8 minus 11.65, that puts my break even at 29.15 instead of 29 I said 45. But I'm probably not going to get exactly the mid price, but it's pretty close. It looks like I could easily get 11.35 out of the 30 call for January 21st. So this is how I would convert. If I go back to Questrade, go to my account, I basically just, if I want to move it from my margin to my RSP, I basically have to close the position. So I have to buy back the put. So I click on buy, pay whatever it's worth. So let's say here I close it for 55 cents, put my order 55, I buy to close. So now I spent 55 cents or $55 in this account to close a trade, and then I go to my RSP account, and then I would do the covered call trade at exactly the 30 strike. So I click covered call here, click on the 30 strike, and then I would buy 100 shares of Lightspeed at whatever the current market price is. But I know that I should at least sell the call for 11.35. So my net cost should be at least 29.45. So I'm going to put a net cost of 29.45. So a net debit of 29.45 out of this transaction. So this is how I would convert a naked put into a covered call. Now another example of a put that's maybe in the money, we could just, I guess I can look at SPY here and just pretend like I had a put that's in the money. So let's just say I had the 490 put. So let's look at what the 490 put is trading for, and let's pick an expiry. This is just for simulation. So let's pick the January 21st expiry, and let's take the 475 put, or for the 480, something not too far. So this put is in the money. Let's say I wanted to close it, I'd have to close it for $10.70. So if I wanted to convert it into covered call, then I would just have, so that means my break even is, if these prices are accurate, so 480 minus 10.7, 469.3, that's my break even, or that's how much my net cost should be on the covered call that I'm going to open if I want to keep this trade equivalent. So 480 minus 10.7, so 469.3 should be my net cost for the covered call at a 480 strike. So if I turn this trade into a covered call like this, buy 100 shares of SPY, sell, I said it was January 21st I chose, and I said 480 call, 480 strike. So my net cost should be around, what did I just say? I said 469.3, and now it's giving me 470.6 minus 2.63. So it's actually giving me a much better net cost, but these values might not be accurate because the market is closed. So let's look it up on the SPY. Let's just see what the bid and ask is. So we're gonna go to January 21st. Let's look at the call for 480, I said. Yeah, let's look at the 480 call. Okay, this is showing all the strikes. So let's scroll down faster. 480. So the 480 call is trading for, all right, so 263. So this was accurate. So because it was a liquid stock or liquid underlying, so the last traded price was pretty accurate. So yeah, so as you can see in this situation, I would be able to lower my break even unless the put is not accurate. Let's go look at the value of the put. So the 480 put is trading, yeah, there you go. The put was not accurate. The last traded price of the put was not accurate. I had done 480 minus 10.7, but as you can see, the bid and ask is around 11.6 and 11.87. So probably gonna get around 11.75, let's say. So the true break even is around 480 minus, because I'd have to buy, yeah, this is the value of the put that I'm gonna have to buy back because it's in the money. So 480 minus 10, not 10, but 11.75, let's say. So my break even would be around 468.25. And as you can see, the covered call break even here is around 467.97, 467.97. So pretty close, about 25 cents away. So yeah. So in terms of execution, all you have to do is buy the put. But before you buy the put, you need to know what your break even is. To know what your break even is, basically just take your strike minus what you're gonna have to pay to close the trade. So in the case of, if we go to Lightspeed, the example of Lightspeed, my strike is 30 and I'm gonna have to pay 55 cents to close it. So 30 minus 55 cents. So my break even is 29.45. So now this has to be my net cost for the covered call that I'm gonna buy. So if I go open a covered call on Lightspeed, I need to make at the same strike, same expiry. That don't have to make it complicated. I just have to make sure that I'm paying not more than 29.45, and that will be the same thing as the naked put. Now my strike in this case is 30, so as long as Lightspeed stays above 30, I'm gonna have to sell my shares at 30. So my profit is confirmed when I sell my shares, because I'll get my money back at 30. I'll get 30 times 100. But remember, my net cost was not just 29.45, but it was also the put that I sold, the initial $1 that I sold. So that's how I convert my profit by converting it into a covered call, is once the stock expires above the strike. So let's look at a real example that I actually did here on Zillow. So this is the covered call trade, but let's go to my margin account to see the put that I had to buy back. So Zillow, there you go, December 17, 75 put. I ended up buying it for $20.20. So that means my break even is 75 minus $20.20. That means the covered call that I'm gonna have to buy I have to pay less than 54.8. If I go to my RSP, you can see that I paid $53.30. Now it's a different expiry. Remember, you can see this here is February 18 expiry, while in my margin account it was a December 17 expiry. So I rolled it at the same time. Now how much credit did I roll it for? Well, you could see that I said that buying this put for $20.20 is equivalent to 54.8. But if I go to my RSP account, you can see I paid $53.30 to roll it to the 75 covered call. So basically the extra credit I collected by rolling it from December to February, but same strike, is the difference between 54.8 minus 53.3. So that's an extra credit of $1.50. Now, how do I get out of this trade? How do I make up for this $20 that I had to pay in my margin account? I paid $20, and then I still paid an extra $53 in this trade. How do I get this money back? Well, the way I get this money back is when Zillow eventually comes back up above 75. When it comes back up above 75, I have a net cost of $53.30. So 75 minus $53.30, I make up that $20 that I spent, and a little bit of profit, of course. So the problem of converting into a covered call, for me to close the trade, obviously, well, it's the same thing actually. In the case of the put or the covered call, the stock needs to be above my strike for me to close the trade and confirm the trade. In this case, I need Zillow to be above 75 by February 18 for me to recoup the money that I spent closing the in the money put in my margin account. And if it's not, then I'm just gonna have to roll the call, sell another call, collect maybe another $1, maybe go to March or April, collect another $1, and wait until the stock comes back up. Now the reason that I moved from my positions from my margin account to my RSP is because I wanted to avoid getting a margin call in my margin account. But my RSP is a cash account, so you can't get a margin call in a cash account. It's just dead money if it's not if the stock's not moving or recovering. But in my margin account, as the stock drops, my available buying power decreases and I can get close to a margin call. So that was stressing me out, so I decided to move it into my RSP account. So going back to the how-to, basically just buy it back. I'm buying back the put, so basically put the order for 55 cents to buy it, and then covered call, once again, I'm also buying in this case, and the selling will happen at expiry if the stock is above the strike. So in the case of the covered call in my register account, then I would be putting, I think I said 29.45. And in this case, I'd be sending the order, but I'd be buying the covered call. So I'm buying 100 shares and then selling the call, so that my net cost is 29.45 in this example. And that's how you can convert a naked put into a covered call. All right, if you have any questions, in the comment section below. Like always, if you're gonna open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. Thanks for watching.